Brad Williams, Frugal Finance. Let's talk about a comprehensive European bond option. Example, this is going to be pretty heavy in the calculation side, on the equation side. Well, let's get started here. All the complications associated with applying the Black model to value a European bond option can be illustrated by working through an extended example. Consider a European bond option that expires in 7 months on a T-note that matures in 28 months and has a semi-annual coupon rate of 8%. The exercise price on the option is 1020. The note has 2 months of accrued interest in the following remaining cash flows, assuming the par value of 1,000. Cash flows, $40. Cash flow, 10, 16, 12, 28. Got that, 40. And then maturity. We get principal and interest. Table 19.6 presents information on two term structure environments for 48-month horizon. For this example, we will use the upward sloping yield curve presented in column 2 of table 19.6. The third column of the table shows the appropriate zero coupon factor for each month, and we will use monthly compounding for all calculations in this example. Based on the cash flows stated in a yield curve data of table 19.6, the actual value of the bond is as follows. 40, all we're doing is discounting the coupons and the principal with interest. Here is the price of the bond, 105.43. Here's the equation. We've done this. If you've taken my previous courses, and if you took future zeros or the continuous compounding courses, I illustrate this comprehensively. With 2 months having elapsed since the last coupon payment, the accrued interest on the bond is 0.333 times 40 equals 1333. Corresponding quoted price of the bond should be 103,821. The present value of the future cash flows minus the accrued interest of 1333. So we have this 333 early because we're paying this, the 2 months having elapsed, accrued interest, so we have to take that into account. Sample upward and downward yield curve. We have downward, we have upward. How do we go from term to maturity? Annualized par yield to zero coupon bond. Well, you're going to see this formula and it's going to get rather ugly. And I took the time to do this. Be patient. When you're working through trying to compute the zero coupon bond, you're going to need to implement this kind of ridiculous strategy. You can also use the price function in Excel, but it gets kind of tricky and over again. So then we have 100 times 1 plus C36 times 1 divided by 12. Divide this by 100 by C36 by D35. Move forward, move back, move forward, move back. So you're going to do this over and over and over until you get to this point here. And this is 48 periods. Must have been a rainy, cold Saturday morning or something, and I did this. We're going to use upward sloping yield curve. What information is of interest here? The forward price of the bond. We need the forward price of the bond 7 months from now. During that 7 months, the bond will pay a coupon. Here's your coupon right here. Yellow represents the coupon. The bond will pay a coupon. This is directly analogous to a dividend on a stock. Both the coupon payment on the bond and the dividend payment on the stock reduces the future value of both instruments from what they would have been without the payment. Therefore, in projecting the forward price of the bond, we need to take that coupon payment into account. We can use the current cash price to find this forward price by subtracting the present value of the intervening coupons and compounding the results forward for 7 months. So that's what we did here. Notice here, we have this, and then we're going to look at this compounding. Forward price equals current cash price minus present value intervening coupons times the zero. We have 40 divided by 1.019 right here. And discount it here. 1.051 minus 39.25 right here times 1.0339. Here's our forward. Here's our price. Here's our zero. Times 1015 minus 40 divided by 0.019 equals 1.039 equals 1046. here it is, 105 minus 40 times 1.0339. This is our zero coupon discount factor. And we're discounting this 105.1 with coupon. All we're doing is discounting this. This has already been discounted. Then we're discounting that coupon to come up with this ultimate number. And that is, as an alternative, we can find the forward price for the expiration date of the option by using the term structure to compute the bond price as of the date. 7 months from now, the bond price will be between coupon dates, with 3 months having elapsed since the last coupon payment. The forward bond price will be the present value of the remaining cash flows valued at that 7 months from now. This equates to this. This equation is comparable to this number here, which is 10461, and here it is in action. We took 1, 2, 3, 4. So we took four periods, and we discounted it back at, look at the numbers here, 10493, discounted this coupon here, and we took this coupon here, and then we took the last principal, we took 1116, and then we took 1.538. Now keep in mind, in my haste, I wasn't paying attention to the fact that I hid some rows. Just be aware when you see numbers like 1.538 and you're shaking your head going, how did we go from 1.018? It's because we went from row 50 to row 77. Just be cognizant of that. Then you're just going to go through and crunch the numbers. So you're going to get a 10466. Either of these equivalent methods, notice we used this approach, or you can use this approach. Either way, you're going to get the same answer. The volatility of the forward bond price, I showed in a previous session how to do this using the option pricing model. You can use a different format, but let me just go through and we'll walk through this, and maybe you want to do it this way, using Macaulay duration, or you can use this other format. We also need the volatility of the forward bond price. As mentioned above, the volatility of the forward bond price is not immediately available. Furthermore, there's not even a series of forward bond prices that we could use to compute an estimated volatility from historical data. This contrasts with the futures market, in which future price quotations are available each day and can be used to estimate the volatility of the futures price. However, there's a variety of time series for yields on bonds of various types, such as treasury issues of various maturities and AAA bond yields, as well as many others. At the expiration of the option, the underlying T-bond will have a maturity of 21 months. It's fairly close to a 2-year maturity. Let us assume that the annualized standard deviation of the 2-year Treasury bond is 0.2. To emphasize, this is the volatility of the yield, not the bond itself. We can use the yield volatility to estimate the volatility of the bond price to serve as the volatility input for the Black-Scholes model. So we're going to use Macaulay duration and Macaulay's modified duration of a bond as follows. D is equal to, you're going to have time, you're going to have a summation of, and I guess M will be Macaulay's, and then I guess C of T would coupon. 1 equals yield to maturity. So we have this equation, and where C T of R is the cash flow from the bond at time T. All right, I said coupon, but cash flow. I wasn't even close. YDM is the bond's yield to maturity expressed in the same time units as T. Note that the modified duration is just duration divided by 1 plus R. Then, the resulting duration measure will be expressed in the same time units. Duration price change formula is as follows. So we're going to have, looks like Macaulay's modified duration times looks like yield to maturity, where TM is equation 9.8 is the yield to maturity expressed in annual terms. This holds for a parallel shift in the yield curve and results in an approximate price change that's quite close to the actual price change. From the price change formula, it follows that you're going to get this formula here. We're just going to do some modification here. The equation looks like we have some variation here. Given the annual yield to maturity of the forward bond, AYTM, we can compute the modified duration, M of D. Then, given the standard deviation of the forward bond yield, we have the standard deviation of A YT of M. We can approximate the standard deviation of the forward price right here. From our forward bond, the monthly yield to maturity is 0.005231, which satisfies the forward pricing equation. Notice the months. So we're going to have this forward price 3, 9, 15, 21. We did this earlier, up above. We're going to use 40. YTM equals 0.005231. Trial and error, 40. We're going to find out what's the final number. We have to equate this rate to 104661. The annualized yield to maturity, assuming monthly compounding, is 6.4607. 1.058, this number here, trial 21, annual minus 1 equals 6.46. Wow. Come up for a breath of air. That's a lot of work in order to crunch these numbers and get the appropriate volatility. That's just the annualized yield. Now we're going to move on. Next, we find the M of D, Macaulay duration. So we got 3 times 40, 9, 50. What are these numbers? This is the quarterly compounding. We're looking at the duration of this, which is 19.78. Started out, what was it, 48 months? The Macaulay duration is 1978, right here. The MD measures in month is 1978, so the annualized MD is 1.643 equals 1978 divided by 12. Recalling that we are assuming a standard deviation of 0.2 for the 2-year treasury bills, we have in annual terms, standard deviation is equal to 0.21298. We now have all the required inputs for the black model. The forward price is 104661. The time to expiration is 7 months, 4.5833. The exercise price is 1020. Standard deviation of the forward price is 0.21298. And the 7-month factor is 1.0339. We begin by computing the DISA 1 and DISA 2 terms. And we're going to plug and chug here. We're going to DISA 1 of 1.59. We're going to DISA 2 of 1.57. Going to round those up. Then find the cumulative normal values for the put and call. We have the normal of 1, so we have these numbers here. We're just going to use Excel, normal distribution, then norms distribution. So notice norms distribution, don't use norm distribution. There's 2 different tools there. The value of the call and the put are as follows. Again, we're just plugging and chugging. We've done this all along. If you want to know more about the meat and potatoes of the Black-Scholes model, in other words, the internal logic, just let me know. I'll provide some information or just research it. It's time consuming, it's complex, but it's not something that comes easy. It's serious math and a lot of time and a lot of patience that Scholes, Black, and Merton collectively put together. So here we have this value of the call and the put. Call is this, and you can just replace the numbers, and then the put is this. So it's 26.13 and 39 cents. Therefore, the call is worth 26.13 and the put is worth 39. Lots of work. Because somebody's already done the work, now it's just a matter of you understanding the logic. Take the time, reread this, crunch the numbers, then come up with your own hypothetical and see if you can create something here. Brad Williams, Frugal Finance. Thanks for watching.